Did you know that over 85% of actively managed mutual funds underperform the S&P 500 over a 15-year period? That means most investors would have been better off just buying an index fund and doing nothing. Why do so many people still pour trillions of dollars into mutual funds? Today, we're breaking down the harsh truth about mutual funds that the financial industry doesn't want you to know. Welcome back to Simply Money. For decades, mutual funds have been marketed as the best way for the average investor to grow their wealth. They promise diversification, expert management, and long-term growth. But here's the problem. Most mutual funds actually work against your financial success, not for it. Let's dive into the hidden cost, underperformance, and deceptive practices that are draining your wealth. The biggest issue with mutual funds, fees. The average mutual fund expense ratio is between 1 and 2% per year, but that's just the beginning. Once you add the trading fees, commissions, and tax inefficiencies, the real cost can exceed 3% annually. That may not sound like much, but over time it can cost you hundreds of thousands of dollars. Imagine you invest $10,000 in an index fund with an average return of 8%. Your investment grows to about $100,000 in 30 years. But with a mutual fund that charges 2% in fees, you only end up with around $66,000. That's a $34,000 difference just in fees. And speaking of performance, here's another shocker. Studies show that over 85% of actively managed funds underperform the S&P 500 over 15 years. That means most investors are paying extra for so-called expert fund managers who don't even beat the market. Now let's talk about the different types of mutual funds and why they aren't all they're cracked up to be. 1. Actively managed funds. These funds try to beat the market by picking stocks, but studies show most of them fail. Then you have target date funds. These are really big in 401ks. I would be willing to bet if you open up your 401k and look at options, you will see target date funds. And what these are designed for, as you get closer to retirement, they shift your risk tolerance from fewer stocks to more bonds. And these are marketed as a set it and forget an investment for retirement. But many have high fees and poor asset allocation. The third type is bond mutual funds. You'd think bond funds would be safer, but many charge huge fees while offering lower returns than simple bond ETFs. And here's the kicker. The mutual fund industry spends millions on marketing to convince you these are the best options. Big firms like Fidelity and Vanguard actually make more money from their actively managed funds than their low-cost index funds, even though the index funds perform better. Still not convinced? Here's a reality. Most investors don't realize how much they're losing to mutual funds. A study by Dalber Incorporated found that the average mutual fund investor underperforms the market by 3 to 4% per year because of poor fund selection, fees, and emotional investing. That's right, even professionals make emotional decisions, thus why they don't outperform the indexes. That means if the market returns 8% annually, a mutual fund investor might only see 4 to 5%. Over 30 years, that is massive. Instead of retiring with $1 million, you might end up retiring with just $500,000. That's half your money gone. Mutual funds come with high fees, they consistently underperform the market, and they lack transparency. Yet the financial industry keeps pushing them because they make billions off unsuspecting investors like you. Now, I want to hear from you. Have you ever invested in a mutual fund? What was your experience? Let me know in the comments below. And if you're looking for investment advice, don't forget to subscribe and hit that notification bell so you get notified of upcoming videos. Here at Simply Money, we're here to help you make informed decisions. I'll leave you with this. I've invested in mutual funds because my 401k at different companies, that's all they offered. And as soon as I left those companies, I rolled those over into my personal IRAs and invested in ETFs and index funds. Sometimes you don't have a choice, but if you do, why are you still invested in mutual funds? Leave me a comment down below. What's your opinion on this? And if you like this video, hit that like and subscribe button, and we'll see you next time on Simply Money.